Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @find_finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. Why I'm buying stuff, you can see. When I'm buying things, I communicate through midweek updates and Q&A sessions on the weekends, that information. If that interests you, definitely sign up. Special is the coupon code. If you just want to try it out, all right, type in special for the monthly membership. It's $25. It doesn't bind you into anything. If you want to stop right and only have that 1 month, you can do that. Or you can swap from a monthly to a yearly, grab more savings, swapping to a yearly membership if you'd like to stay. And then you can stay for a year and try it out and see what the returns are. This past, I would say 2025 has been an incredible year. Lots of people with lots of gains. I would say the gains are somewhere between maybe 40% and 120% for most people's portfolios, depending on how they weighted the companies and when they purchased those companies. But I would say they saw a lot of returns that people were sharing somewhere in that range. So that's kind of what's going on this year. And if you want to try it out, yeah, definitely try it out. Dow Gold equals 1. It says another obvious chart if silver were to play out like this. Yes, we are eventually going much higher, but keep an open mind as to just how far we can correct. You know, I bought a bunch of silver. I bought some back like 2005, 6, 5, 4, I don't know, somewhere way back then when I first started investing. I was listening to Mike Maloney and Peter Schiff and all those guys, the normal crew back then. I waited a bunch. I didn't purchase anything over like $25. Even back then, I didn't purchase anything over 25. I waited. And then in 2018, I bought a whole bunch. And what I saw was this cup and handle pattern playing. I saw the big cup, I saw the move lower, and then 2018 was right in here. It was like that double bottom, falling wedge double bottom. And I was like, ooh, I could buy this. So I bought a whole bunch. Nobody was really looking. And I didn't really care about the path. I didn't care about the path. All I knew is that this cup and handle pattern was coming. Interest rates were getting really low. And I thought we were going to bottom in like 2019. So 2019, we got that 2020 crisis that brought things back. That was unforeseen. I think for a lot of people, the depths of it were. And here we are rocking higher again, right? We're basically breaking that cup and handle pattern. I'll just say this. I don't put any, the path. I don't put any weight on any of these people figuring out the path of this thing. Lots of people are making guesses. I'm sure one or two of the guesses will be right. They will claim victory for guessing the path, which they didn't. It was just straight luck. So I'm not too worried about this path, and I don't know why. I'm pretty happy with having a bunch of silver and platinum and a little bit of gold. I don't even think about selling it. Like it's not a trade. It's a store of savings and wealth, if that makes sense. It's stored savings. So everybody who's doing all these charts and trying to predict the path, I don't know, man. I just don't care. Like it's a waste of time to dwell too much on the path. Now, if you're, some people would say, well, I'm not in it and I want exposure. Where can I buy it? No one's going to know the exact price that it's going to bottom at. I didn't know that 2018 was maybe as cheap as it was. I just went because it was cheap. It was underneath the cost curve, and that's when I know to pull triggers. Platinum was the same way for like 4 years. You had 4 years to accumulate the living crap out of platinum. I was pulling triggers left and right when it was cheap, underneath $1,000, underneath $900 with premiums, And I viewed it as savings. It was the least risk, easiest play that I could find at the moment, and I just pulled triggers when I could. And then what happens is the price starts to break out, people get interested, and then they say, well, is it a good time still to buy? You can't use price as your measuring stick. Like, you can't look around the markets and just watch things that go up hundreds of percents, or if it's up 70%, 100%, and be like, oh, is it okay to buy now? That's not what you want to do, guys. You buy patterns, you buy valuation, you buy underneath cost curves. You're being like a guppy or a minnow running around chasing crap, versus a shark. A shark notices when things are cheap, and then you just get in there and you tear it up. You tear it up when it's cheap. You deploy the capital when people just don't give a crap, or you deploy it when people are scared. And they're scared when price is low. It's like the exact opposite of everyone and what they do when they purchase, I don't know, like Nike shoes, or when females go, oh, there's a big sale on. Just do the same thing with stocks. Forget what other people are talking about. Forget what they say. Forget what they are doing. Focus on what you're doing. Focus in your lane. And when stocks go on sale, and think of this as not like go on sale like this week or next month. Think of this as like watching things for years, and then you see something go down a lot, and it's bottoming, and bottoming, like you get this squeeze into a corner there, and then it starts to bottom. Like, this is a huge accumulation zone. So accumulate it when it gets on to the right side, and then wait for the big move. People will say, well, that's an opportunity cost. What's the opportunity cost here? Guys, I just find that like it's the wrong question. It's the wrong question. The right question is, how much more downside does this have? And what is the potential upside? If there's not much downside left, which you'll never get perfectly, but if there isn't much downside left, and the chart looks decently good, maybe it's a double bottom or inverted shoulder, head, shoulder, and then whatever you're buying is incredibly cheap, even better if it's below the cost curve, as long as it's not going to go bankrupt. You got to pull triggers. You can't wait for, in my opinion, if you want maximum returns, you can't wait for price to jump over some whatever. Like, everyone tells me that the trigger is price breaking some trend line, generating some momentum. But the lack of momentum before it, the lack of downside momentum existed, which means every move heading higher, when momentum starts to increase, is preceded by lack of momentum before it. And if every time that the momentum move that jumps is preceded by lack of momentum, then why aren't you buying it in the lack of momentum area? So then you have to look at the difference between the move of if you have to sit in it for 6 months or a year, what other opportunity is better than that? And if you can't time the bottom perfectly, that means that you're not wasting any opportunity. If you're buying a bottom and waiting for 6 months to a year, what that means is what it takes to buy bottoms. Then you look at the strategy and the return of that strategy. If that strategy and the return of it beats all other strategies, then in the beginning, you need to be prepared to wait 6 months, year, 2 years, 3 years for that to transpire. It's all about strategy 1 versus strategy 2 versus strategy 3 versus strategy 4. and then you compare strategies. And what I've found is that there is a superior strategy that works for me and my approach to the markets that most likely will beat all other strategies. And it's not just for me. It will beat all other strategies, even with better players at other strategies. And that's what I've found is a strategy that works the best, in my opinion. So when they focus so much on the path and not so much on the drivers, what is driving silver higher? Is it this technical chart? No, it's not. I can tell you what my best estimation of what the driver is. It's the lack of other investments that are going to work in the market conditions that we are in. People are selling bonds, which is why interest rates are going up and why the government is so worried about rates going up and the demand for their bonds. It's countries' unwillingness to buy each other's bonds, which then flows into commodities and precious metals. And eventually, if rates continue to go higher, it's going to pressure the stock market. And if the stock market's not working and the bond market's not working, where's money going to go? It's going to go to precious metals and commodities like it has in previous bull markets. That's what you should focus on. The conditions that people are trading under. That is the ultimate force pushing these assets higher. The path that people are projecting and predicting, in my opinion, is not the important aspect. Now, I know a lot of people, they're trying to trade the short term. All I'm going to say is good luck with that. That's not where the big money's made. Charlie Munger says, if you take the modern world where people are trying to teach you how to come in and trade actively in stocks, well, I regard that as roughly equivalent to trying to induce a bunch of young people to start off on heroin. It is really stupid. What does he mean there? He's saying don't trade solely on technical analysis. You know, I used to do that back in the day. I was a technical analysis trader, but I knew nothing, absolutely nothing about cycles, ratios, value, anything. And I can tell you, I wasn't very successful. I wasn't very successful. I needed more than technical analysis only. So then what I tried to do is I tried to use technical analysis to figure out where I was in cycles. I used ratios because I couldn't tell what was undervalued or overvalued from a sector perspective by pricing it in dollars. It was a huge mess. So I had to figure out to get my unit of measure to a solid measuring stick. I had to get it to something like 1 ounce of gold or 1 ounce of silver or something that was stable in terms of measuring that didn't move. Once I started tying cycles and I locked down my measuring system in terms of ratios, the technical analysis became more valuable because I wasn't looking at short-term market movements. I was looking at long-term cycles. And then I could start to pinpoint cycle tops and cycle bottoms. That is where the value came. If you're just trying to short-term trade, I mean, you're not going to make any money. You're just going to lose your money, in my opinion. And I think Charlie's right here for the most part. Robin Brooks says the precious metals bubble, going straight off with the bubble call, is clearly bursting. Oh, he's saying it's over. The catalyst for this was the IMF WB meeting 2 weeks ago. As I flagged in my post during the meetings, this is dollar positive because underneath all this, people are going back to U.S. exceptionalism. Good luck with that one, Robin. Good luck with that. I think that this is a pullback in a much larger, big picture cycle. The cycle is going to be driven by increasing interest rates with time. In the short term, I'm not saying I know where interest rates are going to go in the short term, but long term, rates are going to go up. and then money's going to flow into precious metals and commodities. We're going to get a big old boom out of this. In my opinion, Robin is wrong, and he's not looking at what I would say are the leading indicators. Could we have the overall stock markets go up in the short term? We could. Not saying we can't. Could interest rates fall for a period of time? That also could happen. It could. But in the big long-term secular trend, higher rates, which means higher highs and higher lows, and it will put pressure on the stock market. It will put pressure on the bond market, and we'll see metals go higher. Stocks pumping to the moon. Oil, gold, bonds are down. I smell a rat, says Calvin Froge. And, you know, when you view the world through valuations, which I think Calvin does, which is completely correct, you see these overvalued sectors go up and you see these undervalued sectors go down. And I think a lot of people look at it with kind of like a big question mark, like, how is this undervalued stuff in an inflationary environment going down, while this other stuff, which is completely and utterly overvalued, continue to go up? And that's where you kind of just have to disconnect. It's like, you know what? I got to be patient here and wait for this stuff to go up. It's the only thing you can do if you're a value guy. And I agree with Calvin's approach. Totally agree with it. Against all odds, industrial stocks just hit a new all-time high this morning. They're starting to break out here for XLI. That's something I also watch. That's looking interesting. We've got Link. If you've got 2.5 million sitting around, a 9.25% savings rate means $325,000 a year, no stress, no risk, just passive income. Why are people not doing this? Well, I mean, 2.5 million bucks just sitting around. You got to save that. That takes a lot of work, especially if you're starting from nothing. And 9.25% savings rate, that's a pretty high savings rate. Where are you getting that? I mean, that's a lot. And they say savings rate. I think they mean interest rate. But yeah, I wish I could get that with risk-free return of 9.25%. I don't know where that is. Are you talking about some sort of company bonds or something? Art Berman says, look at all the oil on the water. Bearish, writes Javier Blas. He says, this other guy responds, call me when it shows up on land and kills price. Until then, you're trading vibes, not barrels, replies that person. Oil on water is a red flag for sure, but hardly proof that there's a glut. There you go. That's the opinions of others. Rolling down, here Javier says, I'm seeing some top oil bulls saying that $45, $50 a barrel prices are entirely possible. With bulls like these, who needs bears? I don't even, a lot of people talk about potential recession and then low prices of whatever it is. When gold was like 1,500 or something like that an ounce, Heinrich Zaberg was posting clips about $900 gold. $900 gold. And there were other people too talking about how gold was going to go way below $1,000 an ounce. What happened in reality? Gold went up and we're at like 4,000 or whatever. I don't even know what it is right now, but it's like $4,000 an ounce. I'll just make a guess there. $3,800 to $4,200 an ounce. Boy, did they blow those calls. You know how many things I've listened to over the years of people just blowing calls left and right? Blowing it, sucking it. They were just absolute wrong calls all over the place. Harry Dent calling for crashes every single year since 2012 or 13 or 14, somewhere in there. I mean, every year he'd be like, yeah, we're going to have a 90% decline. Wrong the entire time. Peter Schiff, $5,000 gold every single year, 2012, 13, 14, 15. All these wrong calls. And you know what kept you in the good? Buying undervaluation, avoiding overvaluation. You could have killed it the entire time doing just that and never following any of these price predictions. You know what I'm doing? That exact approach. Buy undervaluation, get some good technicals in there, mix it all together in this soup of a setup, and then be patient. Patient to have it work out. But people are going to say, oh, but what about the opportunity cost? Show me a strategy that's better. Show me the money. Show me the money. Not only should the lonely and uncomfortable position be tolerated, it should be celebrated. Usually, being part of the herd should be a reason for worry, says Howard Marks. Undervaluation is lonely. Emerging markets keep outperforming the United States. Shoulder, head, shoulder, bottoming pattern, breakout. You guys have heard me talk about emerging markets. It's such a good opportunity. They pay 8% dividend yields. Some of them pay 15% dividend yields. I'll take it. I'll take the dividend yields. I'll take the cash. I'll take the inverted shoulder, head, shoulder, bottoming pattern. And I'll just sit in it. I'll sit and I'll wait. Wait for a weaker dollar, wait for interest rate cuts, whatever the heck they want to do. Wait for inflation, because they have to print money in order to keep this system alive. It's all set up here, guys. It's all set up. It's all it is. Setup after setup. And then just grab the setups on the right-hand side here of the shoulder. Oh, but that hasn't broken out yet. Oh my God. Stop with that crap. Stop with that crap. What that means is that you have no idea where we're at in the cycle. That's like saying we don't know anything about cycle analysis. Hey, I don't know anything about shoulder, head, shoulder bottoming patterns. I don't know anything about other sectors doing the same thing at the exact same time with great correlation. The oil equities have already bottomed. There's other sectors that have already bottomed, and they all run with emerging markets. So you think that emerging markets is going to disconnect itself from all of those other commodity companies and just happen out of nowhere to just disconnect forever? I mean, they're already cheap as hell. I mean, your price to earnings ratios on some of these are single digits. I mean, what are you waiting for? I know what they're waiting for. They're waiting for price to go way up, and then they have to chase into it. That's what they're waiting for. They're waiting for price to be the factor for them to decide when to purchase. Agricultural commodities are the next big trade. Wheat is sitting on a 25-year uptrend support line. So is soybeans and so is corn. They're all doing it. Fertilizer's already bottomed and breaking out. We're going to wait for this to go? Let's go wait. Yeah, let's wait for the price to go up 100, 200%. Buy it at its peak and then have it fall on us. That's a great strategy. But that's all I've got for today. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special is the coupon code. And that's all I've got for today. I'll be releasing a midweek update. Look for the midweek update on the website. And it's been uploaded. So go check it out. All right, guys. See ya.